Okay, the firm and market structure. So today we'll cover the firm and market structure and we'll understand business cycles. Okay. Now, the key learning objectives on the CFA curriculum from this is to understand what is the meaning of the words break-even point, shutdown point, and as I did towards the end of this lecture, we'll understand which are these points of production based on the cost curves and the MR curve. Okay, we'll understand the different types of competitions, which is very important. There are four types of competition: perfect, monopolistic, oligopoly, and monopoly. We'll discuss those. We look at the supply and demand relationships under each of these competitions mostly, and what is the optimal output point under each competition. That is very critical. Okay. So broadly, the lectures focus on competitions, demand, supply relationships, and the market structure that they operate in. Okay. So if you recall towards the end of essay lecture, if you recall, I've done the slide where we looked at the cost, revenue, and the decision of the firm of whether it should break even or it should shut down. So you see a screen before you guys, and we picked up yesterday. Okay, got it, got it. It's okay?
Yes, now it is visible. Your pen
Perfect.
is
Yeah.
working now? Yeah.
Yeah.
Is the pen working?
Yeah, perfect.
Okay.
Thanks, Pankaj. Okay, so if you look at the scenario, this is a basic thing we covered towards the end yesterday. That let's say you are potentially having a price. Let's say the price is around 100. If the price is 100, right? And at this point, you have the cost curve, which is meeting the price. Okay, now remember MC and AC. This is the point at which I will deliver, let's say, 500 units, correct? At price P1. If I'm delivering 500 units at price P1, my cost is covered by my price, right? So this portion is where my total revenue is meeting my total cost. So therefore, this is a point of break even, which means I break even at this point. If my price goes above this point, I'm going to make a profit, right? But what if the price is not P1, but it's P2? This is important to understand. If the price P2, let's say price is not 100, but it's 80, okay, which is P2, then in that case, with the cover, then in that case, notice that your total cost is not covered. Your total cost is here, right? So at this point, your total cost is covered here. So your revenue is not able to cover cost, but it is able to cover your variable cost, correct? So at price P2, your variable cost, this is a price line, this is your variable cost line. You are able to produce maybe 400 units because obviously lesser price will produce less. And you are just about covering variable cost, which is okay, in the short run. Because in the short run, I'm saying, okay, I'll cover variable costs and I'm sorted. But it's not okay in the long run because the total costs, which include the fixed costs, are not being recovered. So therefore, the decision is shut down in the long run or operate in the short run. This is a very important decision. Because if you're continuing to be at this level in the long run, then shut down operations. But if you're able to sustain this in short run and maybe go up here in the long run, then you can operate in the short run, but please break even in the long run and make profits. Clear? So this cannot continue forever in the long run. That is why I say shut down. Clear? Now let's go to third scenario. So first scenario is where I'm at break-even point. Very good. Continue business for short run, long run. Second scenario, I'm in a loss region, but my variable costs are being covered. So I'll say operate in the short run, but shut down in the long run. Third scenario is this area of the curve where my price is, let's say, not 80 also. My price is 70 or 60 or anything below 80. If the price in the market is below 80 and your variable cost is also not covered, because variable cost, remember, is here, and your lowest variable cost is 80, then it's 90, 100. So if you're in this region, if the price is in this region, you are bound to shut down, whether it's a short run or a long run concept, you will shut down because you are not even covering your variable cost. Okay. Now imagine if I come and tell you that I want you to make some product for me, and you say it will take me 100 rupees to buy the materials and pay the labor. So I will charge you, obviously you will charge more than 100, right? Because you want to cover at least variable cost, the cost that you incur to make the product. If you can't recover the cost that you incur also, then obviously it'll be foolish to make the product. Correct? So the cost that you incur to make the product is called variable cost. I'm not on a fixed cost at all, I'm on a variable cost. Therefore, the answer is shut down if you can't recover the basic variable cost. Operate if you can recover variable cost, but you can't recover fixed cost. Operate and see in the long run. And break even is where you can recover both fixed cost and variable cost. Make sense? Very important diagram for the concept of break even and shutdown decision. Clear? Any questions, guys? If you wonder, how do I get the average total cost curve, ATC curve? Okay, that's very simple. You already know from the lecture, they say ATC curve is a U-shaped curve, right? It first goes low and then it increases. So in the short run, the ATC curve is a U-shaped curve. When I combine various short run ATC curves and I draw a line at the lowest point, I will get something called as the long run ATC curve. It is a combination of all the short runs. So like we discussed yesterday, the girl asked a question, long run, short run. Long run is basically 10 years and all. Short run would be 1 year to 2 years to 3 years. That's a short run concept. So if I combine all the short run curves, I will get the long run curve, which is tangent to the short run ATC curves. Clear? So all the short run ATC curves, tangent will give you. Now you'll notice the ATC curve is U-shaped, which means it is dipping here. It is first falling, then going up. Why? And we discuss this point. Learn carefully once more. The downward is because you are facing economies of scale, right? And the costs are falling. Why? Because of labor specialization, discount inputs, and so on. Basically, we discuss learning curve, right? If you buy more and more materials, the seller will give you a discount. Say, fine, take bulk discount, bulk buying. You'll get discounts, you'll get labor learning to do better, you'll get high productivity. But after a point, even the seller will not be able to sell the goods to you at that price because he'll say, boss, the demand is very high. You're asking for more than what I have. So he may increase the prices after a point. Right? Labor also is frustrated. Their economy of scale, their learning curve is reduced. So you'll notice that after this point, the economies that you were facing earlier will start disappearing. And you will face diseconomies. That is why your cost curve starts going up. And what are those diseconomies? Rising input costs, bureaucracy, monotony of labor. If you're doing the same work every day for the next 1-2 years, it becomes monotonous, you start producing less, right? You get bored. So all these results in your cost curve going up. Clear? So please learn this funda of why is the cost curve U-shaped. Economies and diseconomies. Clear? Now, look at this table, very interesting table. Leave it. On this table, you can make out there is, now this is a typical thing that we learn in cost accounting, okay? Where we try to figure out what is the profit and loss by way of a table called costing table. Okay. Now in the costing table, please learn these 5 points very carefully. Revenue, variable cost. If you remove that, you get contribution. If you remove fixed cost, you'll get net profits. Clear? Okay. Revenue VC gives you CFC gives you net profits. So this is very important for making a decision of whether I should continue or I should shut down. Okay. So look at the chart, guys, and take a minute and work out for me. I just want to mute for 30 seconds. Work out what is the total contribution or the fixed cost. Read the data here. Read this data and tell me the answer. Come on, take a minute. Right, so anyone, what's the answer? What's the contribution? What's the answer? So if you look at obviously 2 million, right? This is 2 million. 1.5 million is the variable cost. Correct? So therefore contribution is 0.5. 1 million is your fixed cost. So you have a loss here. Correct? Right or wrong? Any questions on that? So this is the final solution. Now tell me, what do you make out of this? Obviously, this is not a good situation to be in. Having a loss of 500,000, not a good situation. But this situation is okay because you're still making a positive contribution. Now remember, contribution covers your fixed cost and gives you profits, right? And fixed cost is a long run concept. You cannot sit and say, fine, fixed cost is not being recovered, I will not do the business. Fixed cost is in the long run. In the short run, because your contribution is positive, you will decide to continue to operate in the short run. Clear? But in the long run, if this continues, right, and the fixed costs are not recovered, then you will shut down. So in this solution, you'll say, fine, short run, I'll continue operations. But it's a long run concept, because this figure being negative and fixed costs are not being met, I will shut down operations. Clear? Any questions on this? Take a minute to understand this concept. So this is continuing from what we learned in the earlier slide, where we say that if you're recovering your total cost, fair enough. If you're recovering at least variable cost, you can continue because then you have a positive contribution. Clear? But if you're not in recovering this, then you shut down. Okay? So keep recapping this concept with the shutdown. Now let's come to the next important concept. Types of competition. Okay? Types of markets with competition. Now perfect, there are basically 4 types of markets. Perfect, oligopoly, monopoly, monopoly. Okay, so in terms of types of competition, now remember some of the key things based on which competition decides are the number of buyers and sellers. Okay, let me put the key points, then we'll try to distinguish. Okay, so we have number of buyers, the number of sellers in the market, right? The extent of competition. Okay, how many substitutes are there? Are there many substitutes? Is important. What about barriers to entry and exit barriers? So basically, can you enter and exit easily, or do you have barriers? Okay, that's also very critical. And obviously, when you have substitutes, you also look at competitive rivalry, right? What is the extent of competition that is there in the market? Okay, so if you understand these 5 factors, you will be able to distinguish between any type of competition. Now, let's look at perfect competition broadly. What is perfect competition? Perfect competition is basically what we sort of live in today's world, where there are many buyers and there are many sellers and there are many substitutes also. So basically, if you want to buy a Bisleri water, you have Aquafina, you have 2-3 other types of waters which is available apart from Bisleri. So substitutes are there, buyers are many, seller many. You're not stuck with only one buyer or one seller. And obviously, entry exit is easy. Anyone can start selling mineral water and so on, right? So therefore, competitive rivalry is very high, right? So look at the features. Many sellers, each seller has small market, so many sellers are there. Low barriers, entry exit. Anyone can enter exit. There's no permission required except for FD approval. Homogeneous products, and there is no non-price competition, right? People compete based on price. And the best part in such markets, there is no pricing power. So the person who sells a bottle of Bisleri has no choice but to accept 20 rupees as a market price. He can't come and say, oh, I want to sell my bottle at 25. The market will not allow him to because everyone sells at 20. Got the logic? So we are called as price takers. Who? The suppliers. Right? Now, let's go to next level. Next level to monopolistic is, to perfect is monopolistic competition. In monopolistic competition, there's some competition where there are large number of sellers, but their competitive with each other. Okay. Here I said very low barriers, but in monopolistic, there are low barriers. There are some barriers, but very low. Okay. Here literally there are no barriers in perfect. So in monopolistic, there'll be some barriers. People will not be able to, everyone can't do it. And the most important and interesting part is the products are differentiated. Therefore, there's pricing power. Okay, now the best example of monopolistic competition is mobile phones, right? You'll notice there's Apple, earlier Samsung, there is Oppo, Redmi, Realme, so many other. I mean, not so many also. There's just 10 or 12 players in the market, 14, right? Now, these 14 players are competing each other, right? Obviously, there's some barriers because to do a mobile phone, you have to have some approvals, you have to have capital. But what do these phone companies fight with each other on? They fight on differentiation. They try to differentiate their product against each other. iPhone differentiates on the iOS, the features, right? Some phones have that pop-up camera, so they'll say pop-up camera, amazing feature, differentiated. So every phone is differentiating their product with the competitor. And this allows them to exert pricing power. So here there is pricing power based on differentiation. Remember, none of the four have differentiation as a mode of pricing power. Okay, which obviously means that if they are differentiating, they will aggressively be advertising and branding. So they'll say, boss, my camera is pop-up camera, awesome, big screen, go for it. So they have to advertise and differentiate their take. Clear? Now let's come to the third part. Okay, in the order is oligopoly. Oligopoly is even few suppliers. Monopolistic is 10 to 12 suppliers. Oligopoly is only 3 to 4 suppliers. Few firms. Hardly 3 to 4 suppliers. Right? And why only 3 to 4? Because the barriers are high. The barriers are high to enter and exit. Example, telecom. If you want to start, like when Jio came, right? Before Jio, there was Airtel, there was Idea, there was which was the other one? Yeah, Vodafone, Airtel, and so on. Now, when Jio came, it disrupted the market, right? But that time, only 2 players or 3 players. Why I think there are no more players? Because the setup cost of infrastructure, telecom tower, it runs into thousands of crores, right? You need approvals from the telecom industry. So you have to put wires across the country. So it's a huge cost. And that costs the barrier itself. You can't enter easily. And if you try to enter also, you can't exit easily. You can't just suddenly say, okay, I'm going to stop. You'll have to clear all the dues. You have to clear the wires. You have to clear the telecom dues. You have to pay the spectrum fees. So therefore, the barriers are very high. And therefore, you have very few players. Obviously, the products are very homogeneous, right? And here, the people compete on non-price also. Here. So therefore, they're able to. Now, because there are few sellers, you're able to exert price power. Obviously, when only 3 sellers, they can come together and say, fine, let's decide a package. That's why don't you think when you go to buy a package, Airtel or Jio or Idea, you'll always have similar price. Not that one package is 200 and Jio sells for 50. Today, though, everyone's price are similar packages, right? Because they have the power to do it and there are few firms in the market. Clear? Now, the last one is monopoly. Monopoly, or as the word suggests, and you know it, is basically where there's only one seller. Only one seller, no one else can enter. Barriers are very, very high. Basically, they won't allow you to enter the market. And because barrier is high and there's one seller, there's a lot of pricing power and control. So the person decide what price and what output to give. Obviously, because there's so much of control, they will keep advertising. Best example is Indian Railways, right? You can't go and now start your own railway company or even metro. It is by the government, only one seller, right? You can't start it because there are barriers to enter and exit. And obviously the government can decide, tomorrow the government decides to start increase the fares. You can't do anything, right? Railways, if the ticket is not 20 but it's 200, you still have to use the railways, no choice. Obviously, but the government is using for the benefit of people, so they will make sure that it is controlled, right? So this is called monopoly, right? So 4 types of market, guys. Perfect. Monopolistic mobile phone industry, oligopoly, which is the telecom industry, airline industry also oligopoly. We only 3 to 5 airlines in India, and monopoly where there is one person railways. Now you will look around, you'll see 90% of products you see around are gonna be perfect competition, right? Like noodles, food, bisleri, cold drinks. You'll have perfect competition. It is only some niche products which will have monopolistic, oligopoly, and monopoly. Clear? Now, this knowledge is important because then you are able to understand the curves and the profit scenario under each scenario. Okay? Now, let's understand the first one, perfect competition. Under perfect competition, we learned there are a large number of buyers and sellers. Correct? When there's very large number means there's only buyers, sellers. So obviously, who will decide prices? No one. No one will decide prices. The market will decide the prices. And whatever the market decides, the firms will have to accept the price. So the key word is they are price takers. Right? Now, if you're wondering how the price is decided, simple. Demand and supply. The market will decide what price to sell at, looking at the demand curve and the supply curve. Wherever the two curves meet, that is the agreed price. That price will continue the market. Simple. This price is based on equilibrium. So because let's say, example, obviously it's something we control. Let's say Bisleri. Why in Bisleri is 20 rupees? Because there's sufficient demand and sufficient supply at that price. Right? So every product has a price which is found by the market. Correct? And that price is called the long-term price. Clear? Now your job as a firm is to make sure that you match the price with your cost. Right? So if you look at how a firm will react, what is the optimum point at which, yesterday we discussed, was the optimum point at which the firm will continue to produce? See, now every time a firm produces, its cost will increase. The cost firm will incur a cost. I want to look at what is the marginal cost. The marginal cost is the incremental cost of producing. I will produce only till that time when my incremental cost will match my incremental revenue. Example, if I'm producing Bisleri bottles and I know the revenue from every bottle is 20 rupees. So let's say if I produce 1000 bottles, my cost per unit is 15. I'll keep producing. Obviously, you realize first my marginal cost will fall. So if this is 20 rupees, right? Let's say this is a graph. 20 rupees. This is 20. This is the price in the market. My cost is 16, 15, right? 16, 17, 18, 19. It keeps increasing. My cost as I increase my production will increase, right? My incremental cost will increase. So first it falls, then it goes up 20, 21, 22. So it becomes 21, 22, 23. It's 20 here, it's 17 here. So I will produce bottles till the point my incremental cost of producing the next bottle will exceed the revenue from the next bottle. Obviously, I'm not a fool to produce at 21 and sell at 20. So I will stop here. This is the point at which I'm saying this units is my final unit. This unit pay, I'm making most profits. If I produce more than this units, I'll make a loss. So this is called as profit maximizing output. That is the point at which, very important equation, MC equals to MR. MR is the market price. So MC equals to MR is the point at which a firm maximizes output. Clear? So if they give you the diagram, remember the logic is because you want to match your incremental cost to incremental revenue. Okay? So therefore, in perfect competition, it's very simple to basically find MCMR and decide the quantity. Now, how much profit do you think you're making at this point? For that, you'll have to look at the cost curve because remember, this is only the output, but I don't know what the cost is. So I will need to go to the cost curve. Now you all know obviously from yesterday that I mentioned the cost curve is a U curve, right? Which goes and the MC curve intersects that, right? Okay. Let me do it here only. Okay, so let's say this is my market price. This is MR, which is also market price perfect competition. Okay, this is my price and this is output. Okay, now you know that ATC curve, I'll do only ATC curve, goes first down and then it goes up. MC curve is always down, then intersects here and then it pushes it up. Correct? It intersects the ATC curve at the lowest point, MC curve is here. Now you learned from my earlier diagram, correct? That my MC curve and MR curve is the point at which I will maximize my profit. So this is the output I'll produce. Now tell me at this output, what is my cost? See the cost curve. So my cost is so much, correct? So my cost is so much. So at this output, my revenue is so much and my cost is so much. So what's my profit? My profit is this region. Understood? So this is my profit region. Got it? So I need to draw a diagram to show you how the diagram was formed. Okay. So we have MR, MC and ATC. ATC is like this and MC is like this. This is a point for output and the cost is below that. That's exactly what this diagram is trying to show. Correct? That this is a point at which you will produce and below that is your ATC intersection and this region is your profit region. So this is fantastic. This is what happens, but only in the short run. This will happen. Everyone will come, enjoy profits and make extra profit. Now don't forget this profits is nothing but extra profit you're making. But in the short run, this is what happens. Why am I saying short run? Because in the long run, people will observe, oh, look at the profit they're making. So more and more people will enter the market in the long run, right? And when more people enter the market, what will happen to the ATC curve? The existing firms and the new firms, they will have to start matching the output, the cost, competition, advertising. They have started doing that. So the ATC curve, which was originally here, will now move here, right? ATC curve will go here. So now at this point where MC meets MR, it will also meet ATC and this extra profit that they're making will no longer be available. They'll be at break even. Obviously, break even means they're making normal profits, right? So in the long run, this profit number will be eliminated. This extra profit number, it is called economic profit, and all the firms will make normal profit. Now you'll wonder that's not true because many firms still make excess profit. That's right. But that's till the time there is competition, there are more players, until the time it becomes a long run concept. Clear? So understand from this, under perfect competition, in the long run, no firm makes super profits. Everyone will make normal profits because there's a freedom of entry, exit, no barriers, perfect competition, all substitutes, price takers. So everyone is able to do what they want to enter and everyone will make normal. Obviously, now you'll wonder, some people are making losses. Let's say someone is sitting here, cost. So the loss he bana raha hai. He'll get out because freedom of entry, exit also is there. So in the long run, the loss makers will go out. The profit makers will increase the cost because the other people enter. And effectively, no one makes super profits. Clear? Okay. Again, this is perfect. Don't talk about monopolistic. Don't tell me, okay, Amazon, Flipkart. Those are not perfect companies. Those are more in the world of monopolistic because there are fewer players in that area, right? There are almost 8 to 10 players maybe. There's Blinkit. There's various, there's Swiggy. Even they have entered the regime. So there are fewer players. They are almost monopolistic or oligopoly. Clear? So this is very important to understand. Okay. And similar, if you look at total approach, so obviously marginal approach, remember, so we discussed total revenue goes like this. I discussed curve. Total cost will initially start here. It will first go down, then it will go up. So you will be initially in a loss region, then a profit region, and then again a loss region. So your job is to make sure that you stay in this region. The moment you go here, you will be loss making. if you want to find the point of highest profit, the point where the gap is the biggest, the gap is the most. So this is a point where your profit and your cost and revenue difference is the largest. That is your profit maximizing output. This is using the total concept. This is using the marginal concept. So marginal concept say we found out MRMC curve. Total concept say we found out total revenue, total cost curve. Clear, guys? Okay. So this is really critical. And this is exactly what they're saying will happen in the perfectly competitive markets. Read this line. No firm will earn in the long run. I hope you understand that. Right? Explain to you diagram. Thanks so much. Okay. And the reason is no entry barriers and no exit barriers. So profit makers will enter, loss makers will exit. Correct? And why in the long run, important to understand that price will equal to MR, will equal to MC, and will equal to ATC. So your marginal cost, ATC, everything will cover. See, it looks like this. In the long run, your price will be 100, your marginal cost will be 100, your ATC also will be 100. So therefore, you are making break even, you're making normal profits. Now, don't sit and think that you're making no profits, right? Which fool will do business and make no profits? So remember, when I say that you are covering your you're covering your total cost, you are effectively making normal profit. Remember that. Okay, that's what they factor when they do that. Okay, so normal profits is good. Abnormal profits is not good for the industry because the people will get enriched unjustifiedly. Okay, so this is what I call as equilibrium for the firm. Clear? Obviously, this is industry, so this is individual concept, demand supply line. Clear? Impressive. Understanding that concept carefully. This is obviously, I told you in the earlier diagrams, already repeated. In the short run, you can have a profit, you can have a loss also. Loss is why? Because your average cost is too high. So remember, you can have a scenario where the price is too low and your ATC is too high. Correct? So notice that again, MCMR, where the MCMR meet? Here. Correct? So MCMR meets here. This is the output that I'm going to produce. Correct? Because that's the MCMR curve. But at this point, my cost is so much. See the ETC curve. My cost is so much. So therefore, this region is my loss because this is my sales and that's my cost. This is my economic loss. Economic loss. Correct? What will happen? People leave the market, right? Because they're not able to sustain. In the long run, if you stay, you'll go out of business. Therefore, they leave the market and the long run equilibrium is met with the other existing people. Okay, so hope you realize perfect competition. In the short run, there can be a profit like here, there can be a loss. But in the long run, in the short run, in the long run, it will always be normal profits. Clear? Short run profit loss hota rahega. Long run, it will be normal profit. And the reasons are more important than the diagram here. Please understand the logic and the intention. Clear? Okay. This is how the short-term supply curve reads like. Obviously, you realize in the short run, the supply effectively, they will supply based on the price in the market. So the short-run supply curve will increase as the price goes up, they'll supply more. That's obvious. We learned from the law of supply yesterday, right? But you will supply only at the price, where your MC and AVC meet. AVC, average variable cost. I'm not looking at profit maximum. I'm saying what is the output you'll supply in the market. Obviously, because you know that MC AVC point, because that's the point at which AVC is lowest. Why am I saying that I'll supply at the MC AVC point? Because I told you yesterday, it intersects the AVC ATC curve at the lowest point. So what I want, my cost to be lowest. That's why that's the point I prefer to supply at. And from that point on, I will continue to supply more and more and more and more based on the supply curve. Clear? So learning two things. What is the profit maximization point MCMR. What is the output maximization point? MCAVC. Clear? Okay. Now, this is similar to what we did for the increase in demand, but this is explaining what is the adjustment that you will make for a short run increase in demand, right? Now you know how demand works potentially. The demand curve is like this, right? And we discussed yesterday how increase in demand means the curve will shift to the right or wrong? Okay. Now, if the curve shifts to the right, if the curve is shifting to the right, okay, what will happen to price? Obviously, the price will increase, correct? So the price is P1, it went up to P2, right? Because the demand curve shifted to the right, the quantity also was P1, Q1. Because demand increased, quantity will increase and P2 will increase. Now, this is interesting. Because the price increased, the supply curve, which goes like this, the supply will now be willing to sell. Originally Q1 at P1, the price went to P1, P2. He will happily be ready to accommodate higher quantity because the price is higher. Understood? So as the demand increases, the price is bound to increase. Because if the price does not increase, suppliers will not enter the market and there'll be a shortage of goods. Understood? So when the price is going up, that's only because the demand has gone up and because the supplier is willing to supply only at a higher price. So the quantity movement happens because the price movement happens. And the price movement happens because the demand happened. So simple logic to understand 3 steps. Demand went up, therefore price went up. Price went up, therefore the quantity supplied also goes up. Samjha? So this is the result of an increase in quantity demanded. That's why suppliers today are very aware of what is the demand, what's the price, and what's the supply. Right? Demand goes up, price goes up. Price goes up, supplier is willing to sell more, supply goes up, and therefore quantity demanded and supply goes up. So then your GDP also goes up. Right or wrong? So GDP going up is not a bad thing. Inflation also not a bad thing sometimes. Inflation also because the demand is going up, because the consumption is going up, so the GDP is also going to improve. Clear? So this is the adjustment. Okay. Now obviously permanent, this was a short-term increase, right? What is the permanent increase in demand? Permanent increase in demand. Now, in the short run, in the earlier slide, I taught you how the supply will go against demand is going, so let's adjust. But today, long run, you'll have to adjust it to long run. You can't just say, okay, I'll keep it for the time being. So if there is a permanent increase, then what will happen is the new suppliers will increase, will come the market. Okay. So now understand this carefully. Look at my diagram, then we'll go back to the diagram shown to you. Okay. If this is a demand curve and this is the original supply curve, right? So originally I am standing here. Originally, this is my equilibrium point, P0, Q0, original. Now let's say the demand curve goes up. It increases, right? So based on this supply pattern, supply will be happy, yaar, sahi hai, good, he is able to supply more. The demand curve goes up. The new equilibrium point will now be this much. The new price is P1 and the new quantity demanded is Q1. So there's more quantity at a higher price. Now you realize that's good in the short run, but long run is not good because it will lead to inflation, price increase, the currency value goes down. It's not good for the country, right? So what happens in the short run? When this takes place and the price increases, what does the law of supply say? Suppliers will increase their supply because the price has gone up. So what happens is at this higher price, the supply also goes up. the supply goes up because now there'll be more supply in the market, right? And the supply curve will shift from S1 to S2. Remember I told you yesterday, supply increasing means it shifts to right, not down, but right. So supply curve increases and the new supply curve is now S2. Now what is the new equilibrium point? Look here. This is D2, right? Pehle D1 tha, D2. Where is D2 and S2 meeting? D2 and S2 are meeting here. And notice that my new equilibrium point is actually at the same original price, but the quantity has become Q2. So what's happened is quantity has gone up, but the price has come back to original because that was the original equilibrium price. Got it? So you saw P0 went to P1, more suppliers came, so P1 fell down because you know that supply increase, price falls down. So more suppliers came, P1 went back to P0. The new equilibrium point was Q2. So what's the effect? Quantity has increased, but price remain the same. And that's exactly what the economy will do. It will always bring you back to original price. Why? Because you want no one to make excess profit. You want people to enter, exit as and feel, and you want everyone to not earn economic profit, they'll earn normal profit. Normal profit is what I want everyone to earn. If people start earning economic profit, then there'll be a disparity in distribution of wealth. Clear? So this is what I'm saying. Eliminate the economic profits is what the firms do. Are we clear, guys? Very important. Okay. So demand supply MCAC curve, you'll notice that in the long run with this diagram, which I explained to you, the demand supply, the quantity goes up, but the price goes back to equilibrium. Clear? And obviously that also means that if the price is, now look here, if the price is P0, you're making no extra profit. If the price P1, you'll notice that you're actually making a super profit, which is not good. So we need the price to be P0, not P1, because the price P0, there'll be good demand, there'll be good supply, and there won't be super profits being made by few industries. Okay? Clear, guys? So that was it for perfect competition. Any questions? Now, characteristics of monopolistic competition. Now, monopolistic competition, we already discussed this on the earlier slide where we say that there are not too many large, there are large number of buyers and sellers, but not unlimited, right? Large number of buyers and sellers. But remember, the sellers are still smaller than the buyers in quantity, and each seller has a market share which is more or less 3 to 4%. So we'll have maybe 25, 30 sellers who are selling, and every seller will have a 3 to 4% share in the market. 5%, some have 10%, some have 15%, but all of them have a share. But no seller has a significant power over the price. No seller can single-handedly discuss and decide what price he wants to sell at. Right? Okay. So here we are focusing more on average prices, market prices, and obviously the firms are there, so the collusion is not possible, right? The collusion is very difficult in this market because the number of sellers are still 15, right? So like I told you earlier, product differentiation is the most important feature of this market because people are trying to fight each other based on product differentiation, quality, marketing, pricing, right? They'll put some fancy item, they'll put some features, right? And that's very important because this market has close substitutions, right? This market also has low barriers to entry. So the the demand curve will be obviously downward sloping because here the people are conscious of the price, correct? Okay, you'll notice this message keeps repeating. People are competing on price, quality, marketing because differentiation is the end game here. Okay, right? So how does the cost curve in this market look like? Okay, so like I taught you the earlier price here, this cost curve in this market, demand, this one, equilibrium in this market, right? This is important. So this diagram was for perfect competition, correct? Where I had the MRP price was same. The demand curve also was flat because perfect competition. So the demand curve was also a flat line, correct? Because the price was constant. In this market, the demand curve is different from the MR curve because here the marginal revenue and demand is downward sloping, not a flat line because of perfect competition. So this is how it will look like in the short run. Okay, learn carefully. So this is the MR line. This is the this demand line. Remember, I told you the 80 average cost curve. It might be somewhere here, right? And I told you the ATC, the MC curve will intersect the ATC curve at the bottom and go up, right? And as per what I discussed with you, the profit maximum happened at the point of MCMR. So what MCMR point here? MC meets MR at this point. If MC meets MR here, this is the point at which I'll produce quantity. So this is the quantity I should produce. Now, can you guys tell me at this point what is the price and what is the cost? If you want to know the price, you have to look at the demand curve, correct? This is my demand curve. When this output is produced, I can sell this output at go up, go up, go up, go up at this point. This is my demand curve, right? So therefore I go to this point. This is the price at which I'm able to sell this output, correct? Because this is my demand curve. Demand curve is nothing but the price curve, correct? But at this point, what is my cost? My cost is so much. So if this is my cost, if this is my revenue, my profit will be so much. Right or wrong? So that's my profit area. Okay, obviously monopoly competition will be making profits because there is lesser sellers than in the perfect competition, right? But they will have to maximize that MRMC curve, right? And obviously this guy is making a profit because ATC curve is less. Imagine if another seller was there and his ATC curve was somewhere here. तो वो तो लॉस बनाएगा because ATC is here, cover भी नहीं होगा and he will make a loss, right? So ATC curve अगर demand के नीचे है, price के नीचे है, तो it's good. ATC curve ऊपर है, तो he'll make a loss. Clear? But the good part is this would sustain in the short run. Now again, same logic. If this is sustaining, then what will happen? More people enter. There is not too many barriers. You can still enter. So more people enter market. With that, what happens? The pricing, the costing will go up. Remember, the demand curve price will be same, but the cost will go up. As the cost go up, the ATC curve will also go up, right? ATC curve will go up and will go to sit on the point where MC, MR, and price meet. So this is the point where my AC, ATC, MC price will all meet. And this is the point where there is no economic profit. But this is in the long run, right? So you'll notice in the long run, we are not allowing firms to make profits because that's how the game is played in the market, right? So MCMR ka point ye hai and ATC point is 0 and therefore I have 0. So you may need to understand how the short run, long run concept work, how the short run profits are now eliminated in the long run. There is no longer an incentive to enter the market in the long run. Therefore, there is long run equilibrium. There's no, see, economic profit is now 0, right? So basically, there's no further extra profit. So there's no incentive for people to enter. They'll stop entering. The moment there was economic profit, they'll all enter. The moment profit becomes 0, economic profit becomes 0, they will stop entering. And that is called long run equilibrium. Clear? Any questions? Okay. So we've discussed perfect competition. We discussed monopolistic competition. Okay, pricing, demand, and so on. If you look at this in terms of output, okay, now this is a summary. We already discussed it. This is summary. In the monopolistic, what I explained to you, the demand curve, MR curve looks like this, MC, ATC in the long run. Okay, hopefully MC, MR will be here and ATC also hopefully will be on the long run, and therefore there is equilibrium. You see there's no profit. Same for perfect competition. The line looks flat. Here ATC will probably be intersecting here and MC will intersect here. So here also the pricing is here where there is no profit, no loss in terms of extra profit, right? This is exactly what happens in the long run under both competitions, right? And that's what they're showing you here. In the short run, perfect competition firms do not earn economic profits, but in monopolistic, they will earn, right? But in the long run, both of them will end up with zero. Inefficient resource allocation, ETC not. The reasons are given to you. Obviously, scale of production not high, markup is not there, and so on. Clear? Okay. So they are concepts of how the pricing takes place on the this. Now quickly look at what are key things that is then monopolistic in terms of product challenges. You have efficiency. Now under monopolistic competition like mobile phones and so on, we're not really clear whether efficiency is really there or not there, right? Consumers benefit from advertising. You'll probably see different banks. Example, you'll see Amitabh Bachchan, Deepika Padukone, Axis Bank and so on. Not really sure why you'll have a Deepika on Axis Bank and people want to bank with that, right? You will not bank because you want to see the feature of bank, not the consume, not the film stars. So they're a little unclear. People tend to have choices. It is difficult to sometimes make better decisions, right? But obviously, people feel that the cost of advertising is high. Like tomorrow, if Kohli is advertising something, people might want to buy that. So efficiency is not entirely clear. But yes, you need to make sure that you are competing on product. If you don't innovate, you will not be able to survive, right? Like mobile phones, people have come up with Oppo pop-up camera. Why? Because they know innovation is very important. Correct? Right? So they are trying to have innovation to increase the prices. But close substitutes often will cause them to disappear in the long run. Okay? In this competition, you are always going to find people come up with substitutes. Now you see sometimes see iPhone also there's so many substitutes to that. Very close substitutes. Everyone's trying to mimic iPhone, the OnePlus, and so on. So there's so much competition effectively. In the long run, all the extra profits will tend to go away, right? And obviously, advertisements create perception, right? And that's the main problem where this. Now, advertisement, I already told you earlier, it will increase your average cost. This is why sometimes more advertising leads to high cost and high cost leads to lower profits, right? But advertising may reduce, very unlikely, it doesn't happen often, but it'll reduce when sometimes you are able to bring advertising and shoot your output. Then your output goes up, your demand becomes elastic, and you're able to recover more cost. Clear? Okay. So advertising, differentiation are key features of monopolistic competition. Okay. Now, the third type of market, oligopoly. Oligopoly, if you think of it, just think of the telecom industry sector. In the telecom industry, we have few firms, right? Vodafone, Idea, Jio, or Airtel, where barriers to entry is high, very high, almost. Products may be homogeneous. You don't have like you not like Jio gives you something special. They're mostly same they give you to calling, right? Pricing power is there with this. Okay. So here we have many theories that are very important. Four models, understand them carefully. Kinked model, Carnot model, Nash equilibrium, and the Stackelberg model. Okay. Now basically, oligopoly looks at having these barriers, okay, and therefore fewer suppliers, right? High barriers, reason is because we have high capex, large economies, less elastic demand. The investment is huge, the regulations are very high. Okay. Now, under oligopoly, very interesting to understand, the demand curve looks like this. Okay, it's like this. It kinks here. Kinks means it bends here and then goes down, right? So the demand curve is more of a kink, right? And that's why we call it kink demand curve. Now you'll wonder why is it kinked? The reason is this. Let's say let's say all the mobile phone industries agreed to price their 1 month pack at 300. Okay, let's say Airtel, Jio, and Vodafone said we'll do it at 300. Now, suppose they price at 300, but Jio tries to act smart, and Jio will say, no, let me increase my price to 350. They're like, boss, I feel people like Jio, so I'll make my package 350. Now, when they make it 350, do you think customers will warm up to it? They're like, no, dude, what 350? I mean, I'm getting Airtel for 50 rupees lesser. So more people will shift away from Jio, right? So even if they increase a small amount, look at the difference. The quantity demanded falls by a big amount. So Jio will lose more than what they expected. If they increase by in 10%, they might lose 30%, right? Elasticity is greater. Remember I said elasticity? It's more elastic on top. Therefore, it is like this. It is more flat. And Jio stands to lose more. Let's say Vodafone says, oh, I want market share. So Vodafone says, no, 300, I'll do it at 250. So they'll probably make it 250. They are greedy for more. So they'll make 250. Chalo, they made it 250 is fine. The demand will obviously increase. We know that. But the demand curve is less elastic. मतलब 250 कम किया तो भी मेरा quantity इतना ही बढ़ा. Very small increase. Why? It is less elastic. Why is it less elastic? Because if Vodafone does 250, Jio and Airtel will not sit quiet. They also may run behind it and they also may bring the package to 275, 250. So the market broadly will not react too much. They'll still stay with the suppliers. Vodafone will not gain too much by acting smart because the demand curve is inelastic. So they may gain a small increase, but that's not worth the fall in price. Here, Jio might get a increase in price, but they will get a very big fall in numbers, which will ruin the dynamics. So if you increase the price, you are losing more customers. If you decrease the price, you're gaining lesser customers. This is the more elastic zone, so you lose more. This is less elastic, so you gain less. Got it? Therefore, the demand curve is kinked, and you have the more elastic and less elastic zone, and that is why it's called a kinked demand curve, where this is more elastic, less elastic, and kink curve. तो मुझे ये प्राइस पे खेलना है. वो प्राइस के ऊपर it is more elastic, below that price less elastic. Yeah. Okay. These are very important concepts to understand, that at the kink, the demand curve is more above and less below, and that is where the kink curve is more useful. Clear? Obviously, a criticism that it says that the curve describes the rationale for stable price in oligopoly market, but is unable to determine the prevailing price. It only trying to tell you that was a stable price in the oligopoly, but it can't tell you what should the price be based on the competition. Okay, but the Kinkers pretty much help. It's a good model. It helps. The could not model predicts the behavior of two firms that make up a given market, right? So in oligopoly, you normally have two firms or three firms. In the could not model, they say that every firm will determine its output by assuming that other firm will not change the output. Every firm will say, boss, I'm two firm model. I look at my benefit. They will not look at what the other firm is doing. They will try to maximize their sales, maximize their profits, and they will get sufficient profitability. But they are not looking to maximize the market share. And that's a problem here. So they may result in a fall in market share. Okay, while the market share fall because they have increased prices, right? So the price, if it remains the same the both, the firm with a lower price will always capture the market share. Correct? So Cournot model explains, and Cournot is a duopoly model. What's a duopoly model? Duopoly. Like monopoly is one, duopoly is two. So Cournot model tries to explain that if this is a duopoly market, two people, then they should try to maintain the prices. And based on that, grab the maximum profit share. It's explaining the profits at which the duopoly market will work at. Okay. Nash is a very interesting one. It has the prisoner's dilemma, basically where they say that in this market, you'll always have two people or three people, and those people should play the game as per the agreed rules. And to explain this, they explain a prisoner's dilemma, which is called as Nash equilibrium, where there are two suspects. Okay, let's say A and B are two people, they are criminals, they commit a crime. But you do know, I hope, that police are not able to prosecute someone until they confess or until they are proved guilty. So obviously you realize that if I have two criminals and both of them are not confessing and both of them have remained silent, potentially, then the police can't really imprison them for the crime. They might just hold them for some time and let them go. Right? So what do police do? They will separate the two people. They'll say, okay, you two go to two different cells. And they'll pressurize one person. They'll say, boss, they'll tell A that, see, boss, he's confessed, you also confess, otherwise you'll go to jail. Or they'll tell A that, boss, you confess, I will give you freedom. I will not imprison you. They'll tell B also same thing, that you confess. If you confess, then A will get caught and you will go scot-free. So you never know. A and B are sitting two different cells. They don't know what the other person is doing and they are scared. Now, if A decides to confess, then B is caught and A will go scot-free. This is what A is thinking. Same B is thinking, if I am confessing, then I'll go scot-free and B. But they both don't realize that's a dilemma. And they should realize that if they both don't confess, then no one can be caught, right? Because the law says that you will go scot-free. But both are scared that the other person may rat me out. Okay? So the best answer is both should not confess and they'll receive 1 year suspense or whatever, but that's the best answer. If A confesses and bichara B is silent, then A to gaya, A is free, but B got 5 years. He's ruined. If B confesses and A is silent, A बिचारा silent रह गया but उसको लग गई 5 साल and B goes scot free. Like both stupidly confess, then both will get a sentence and that's also the worst case scenario. So you tell me what's the best case scenario? Both don't confess. If both are silent and strong on the word, they both will be freed within a few months or year. But one of them acts over smart, then 5 years, 2 years sentence is a big deal, right? So that is called prisoner's dilemma. Now, what is that got to do with oligopoly? Simple. In oligopoly, when you have 2, 3 players like Jio, Vodafone, Apple, if everyone honors their side of the deal and maintains their package, right? If everyone play the game as per the rules and no one tries to go overboard, sells more at a high price or lower price or changes against the agreed rule, then everyone will enjoy profits. But if tomorrow Jio tries to increase the price, reduce the price, Airtel does that, the other two don't do it, then there is a disruption. And like the prisoner's dilemma, they will get lesser profits than what they would have got had everyone remained quiet and did nothing. Now you got it? That is what the prisoner's dilemma or Nash equilibrium is all about. Clear? Okay. So this is the connection of the Nash equilibrium to the case scenario. Let's understand from two firms. If both have a deal and both are honoring, right? Both are not confessing, both are kept quiet, then both are going to earn profits. But if one fellow cheats and one fellow doesn't cheat, the one who cheats obviously is earning more profits. And the one who honors, bichara, he earns a loss. Here, if B honors, he earns a loss, but A cheats, he earns a profit, which is actually not good, right? But what ends up happening is both are in a dilemma and both end up cheating and both end up losing the extra profit that they could have made. Got it? So understand one thing. If you cheat, you might end up making more profit, but don't assume the other person doesn't cheat. If both cheat, rubbish scenario, both lost. So what is the best thing to do? Both should honor and both will decide to make super profits. Got it? This is exactly what the prisoner's dilemma is all about. right? Sometimes what happens, one person dishonors, cheats in pursuit of more profits and makes more profit. But this guy made more profits, but you won't forget they will end up here because they both will react and they both will kill each other and they both will end up here. So better not go here, stay here, stay here and make super. Prisoner's dilemma. Clear? Learn this carefully. This comes in a twisted question. You often have examples working on that. The last model is Stackelberg dominant firm, where they say there's a obviously whenever the two firms, three firms, there's only one firm is dominant, right? Like today, if you say Airtel is there, Jio is more dominant, Airtel was dominant earlier. So one firm is normally more dominant, right? That dominant firm will set the price. And all the other chotu-motu firms who are smaller will try to be priced. Obviously, today the fight is among who's more dominant also, but depends. Today, Indigo is more dominant in the airline industry. So Indigo might set prices. Air India may follow them. They may set their own. But the dominant firm model is where they say the dominant firm will set the prices and the other firm will deliver the goods at those prices or at the lower price. Clear? That's called the Stackelberg dominant firm. Any question? So we discussed four models: kinked demand curve, could not model, prisoner's dilemma, Nash equilibrium model, and the Stackelberg's dominant firm. Learn these carefully, read this up on that. Okay. The last one is monopoly, where there is one seller, right? And they're looking for price seekers. Now remember, monopoly has very, very, very high barriers. The barriers could be natural, high capital cost, high investment, high money, high resources. It could be legal also. Like resources, railways, government is saying, no, you can't do railways. There can be patents, you can't enter that industry because there are patents, copyrights, right? So therefore, there's a single price. The monopoly will say, boss, I'm going to enjoy. He'll fix high price, low price. He can enjoy whatever profits he wants. And same logic, he will maximize profits when MR equals to MC. Correct? But obviously, monopoly is always going to have lower cost. So his ATC curve will always be lower. So he'll always have a profit area. This is how the monopoly looks like, similar to the monopolistic, right? We have MR demand curve, right? If his ATC is here, MC is here. Remember MC, ATC. This is the MR curve. He's intersecting here, so he'll go so much, but the cost is here and the price is here. So he's always going to enjoy so much profits because this is a cost, that's the selling price. So this profit is always going to be what the monopoly is making, always. Clear? Right or wrong? This is going to be seen obviously in the short run. Now in the long run, potentially also he may end up making profits because he has monopoly, right? So what the government does, they'll try to contain. Now remember, monopoly is not good because you're trying to cream the market. So the government may say, boss, do one thing, right? I will try to sustain a price. So in a regular pricing market, they'll try to change the cost, okay? So naturally, when a single supplier has everything, right? She will try to produce where MR equals to MC, correct? So if two firms are there and each one producing, potential gains are earned from the monopoly. They'll try to look at economic scale and try to price the goods in such a way that the profit that they make, over profits, is regulated through government subsidies. So the government will try to bring the price down and it will satisfy the seller by giving him subsidies. Got it? So government say, boss, 100 pay mat kar, do at 80 and I'll give 20 ka subsidy. So the customer gets at 80, he's happy, and the company is also getting a 20 subsidy and they're making happy. So this required subsidy is important, looking at the average cost. Here. So same diagram, MRMC, it should have been here, MRMC is here, output is here, the price is here, right? But the government say you charge this price and they'll give them a subsidy of this much. Clear? So the quantity also obviously will have to be increased. They'll say charge a lower price. If the price goes down, the quantity goes up, but the government will give a subsidy to cover the difference. Clear? So that's a regular market. Now we already learned yesterday, if you remember, deadweight loss concept, that if you try to interfere and put a different price, there will be deadweight loss. That's exactly what's happening here. If you see this diagram, MR, MC curve, right? MC curve, MR curve. What's the point of intersection? This one. So I should sell at this point this much because it's MR MC curve, right? Actually, no, the demand curve is here. So here is my price. The demand curve is here. MRMC, this is the output I'll sell. And this output will go at this price. Correct? So this is my total sales. Correct? This is my sales. This is my cost. So therefore, this is my profit area. Correct? Profit area. But look at the next diagram. Suppose I decide I will not put this price. I'll put this price for this output. Then I'll put this price for this output. This price for this. Suppose I do a differentiation strategy. Right, like in PVR tickets, theaters, I put different price for different seats for different shows. If I'm trying to cream the market, I want this price, this price. So I'm trying to not just earn this profit, because if I earn this profit, then this is my deadweight loss. But I want to try and get some of the deadweight loss into mine. So I'll take this. My deadweight loss will reduce to only so much. And my profit will now increase because I took the deadweight loss into my profit. Clear? So what's happening? Some part of the deadweight loss converts into monopoly profits. Correct? When will this happen? One, when you're monopoly, and two, when you're able to decide and dictate how much price at what output I can actually sell. So इसका दो benefit है. The deadweight loss reduces and the monopoly profit increases because the deadweight loss was taken into his consideration. Clear? Obviously, output also will go up, but the overall profits are increasing. Clear? Now, perfect competition versus monopoly, we know the answers broadly. In perfect competition, you have you have many buyers, many sellers. In monopoly, you'll notice the surplus is reduced because he's trying to play the output and the pricing, and there's a reduction in output, right? In monopoly, the surplus is reduced, therefore the sum of the surplus is less than perfect competition. Correct? But obviously, this goes to deadweight loss, right? Monopoly profit is earning extra profit. Why? Because he took the deadweight loss into his category, correct? So other deadweight loss and loss in received output, it comes from CSN produce surplus, which is lesser in the competition in the markets. Okay, price discrimination. When you discriminate prices and you're selling different price to different outputs, you are reducing the inefficiencies. Okay, and that is why sometimes trying to cream the market and get a pricing helps you reduce the overall deadweight loss and the inefficiency in the market. Okay, now quickly summary of what we did so far. Every market structure of the price strategy, you know, under perfect competition it is marginal revenue. The price is nothing but the marginal revenue, flat curve. And the monopolistic competition, marginal revenue looks like this, demand looks like this. Okay, so they're downward sloping curves. Under oligopoly, right, it's not clear, therefore not down sloping, it is kinked. It is like this and like this. Kinked curve. Correct? And obviously under monopoly is also downward sloping. It's not come here. Okay. Now there are two additional ratios to look at the external monopoly. It is called the Herfindahl-Hirschman. Please learn this formula well, and the concentration ratio. Now, what is the concentration ratio? Is nothing but the number of firms and the market shares, right? Now, here you look at four firms. So I want to find out the top four firms in the industry. What are market share? Top four firms. So I'm trying to find the share, right? By looking at how much these four sold against the full market. Clear? Obviously, it's easy to compute, but it does really give you the market power. Example, today, if you see big four audit firms, you compute Deloitte, KPMG, POC, EY, what's the total share? They're around 60% of the total market share. So that's your consonant ratio. Clear? Herfindahl index is where you add the sum of the squares of the market share of all the largest firms. So suppose he has 5% stake, you'll take 5 square. If someone has 10% square, you'll say 10 square and so on and so forth. If the index, obviously, the answer comes to something more than 1800, that means it's going towards oligopoly. If it's 10,000, 10,000 means 100% square, that's 10,000. If it's 10,000, I mean only 1%, and that 1% is monopoly, that is 10,000. So the answers could be anything from 0 to 10,000 to help you understand the index. Clear? So, quick summary. this is very critical to learn at the end. Perfect on large number of firms, monopolistic lesser firms, although a smaller number of firms and monopoly only one firm, right? Products are normally similar. Only thing is in monopolistic you have differentiation, which is happening because they have to compete on product differentiation. Barriers are very low, then they add more barriers and very high barriers, right? And those two ratio I told you, remember Finland index I told you will be 10,000 for monopoly, but 80-100 ke niche for monopolistic. If it cross 800, it will be oligopoly. If it's less than 1,000, it is more perfect. If you look at four firm concentration ratio, if the four firms comes to 100% of monopoly, if it's 60 to 100, then it's almost oligopoly. If it's less than 60 but more than 40, that's monopolistic, and obviously less than 40 means very good. There is perfect competition. Clear? So ये summary थोड़ा याद रखना for the market types to understand how the structure goes. And obviously this continues. Same thing, barriers are low, high, very high. Obviously, if there's low barriers, there'll be no power. If there's high barriers, they'll have a lot of power, right? They're differentiated here, therefore they're standardizing, right? Yeah, is homogeneous, and the number of sellers will vary, many to few to one. Clear? So this is exactly a feature that you want to look at. Okay, this is one example of how to find the index. Quickly look at this. I have 8 producers, right? A, B, C, D, and I have another 4. So if I tell you what is the 4 was a constant ratio. So you can decide, take the top 3, take the top 4. Let's take the top 3. Top 3 हुआ तो 35, 25, 20. कितना हो गया? 60, 70, 80%. If I take top 4, add 10 also, 90%. So looking at the top 3, top 4, you're saying that it's almost leading to plus, right? That means that there's a constant ratio and that's almost looking like oligopoly because you are above the 60%. Now this is more interesting, the index. In the index, you have to take the Hirschman index for the top companies, right? So actually you can take for all also. But if you look at the index, you'll say, boss, okay, for the top firm, you would put so and so. You'll take 0.35 square, 0.25 square, and 0.2 square, right? So that comes to 0.225. But after you merge, it will come 60, 20, 10, 90%, right? So that answer comes to much higher. So the merger, you'll notice the index is showing a very high index compared to the earlier index. So therefore you say, boss, hang on, don't do a merger because the concentration becomes much higher and the index also increases, which is showing monopoly in the market. Clear? So these ratio and the indexes should be learned from a practice point of view. Okay, we'll just quickly see a few quiz on rather than this side. An agricultural firm operating in a perfectly company supplies wheat. If the firm were able to expand production by 10%, what will be the result? So remember, it's perfectly competitive market, right? And they're increasing the sales by 10%. So what will happen to the total revenue? Will that also go up by 10%? Or will the average revenue go by 10%? Or will the total revenue increase be less than 10%? What's the answer? So because perfect competition, the elasticity more or less same. So if I increase my production and sales by 10%, don't forget the pricing is fixed. It's perfect competition, so price being fixed, your total revenue will also increase by 10%. If it was where your price will decrease, maybe, then obviously the average revenue will reduce. Your total revenue will not be 10%, increase by less than 10%. But here it will be same increase, right or wrong? If a firm increases plant sales by 10% and average cost increases by 10%, okay, then what is the firm experiencing? So here the firm is increasing at 10%, but average cost also is increasing. Now, when will the average cost increase? When will the average cost increase? Average whole cost. When it is economy of scale, this is diseconomy of scale, and this is constant returns. So here it's reducing, here it's constant, here it's increasing. Here they say it's increasing. So the answer is diseconomy of scale. Clear? A firm will most likely maximize profits at the quantity of for output for which. Okay, was the answer. I told you. Remember MC, MR. So maximizing output will always happen at MC equals to MR. So please learn that carefully. Right? We did this multiple times. 4, 5, 6. Yes, it's A, B, C. Okay. Now let's go to next one. Consider a firm in oligopoly market that believes the demand curve is more elastic above a price than below the price. So that's which model is it? More elastic above a price than below a price. More elastic. What the model is the kinked demand curve model, right? Which of follows most likely advantage of Herfindahl-Hirschman index relative to the end firm concentration, which is more likely an advantage. Is it simpler to calculate? No, the concentration is much simpler to calculate, right? Wrong. Does it come the barriers to entry? Obviously not. Both the indexes don't come. They always look at what is the ratio. Is it more sensitive? Yes. That is why in the earlier sum we said we looked at the mergers and we found out that the index was more considering the mergers and the impact of the mergers. So the answer is C. Yep. A company doing business in a monopolistic company market will most likely maximize profits. At which point? Now remember, this is output. When will I stop producing? When should I stop producing my output? When my average cost is minimized, or MR equals to AC, or MR equals to MC. Now, if you remember, I told you MR equals to MC will help you maximize profits, profit maximization. But they are asking you output quantity maximization, output. So when I say output, I want to look at average cost being minimum. So for producing output and matching output, it will be average cost. And this is monopolistically competitive market. You will maximize profits when your output is set at a level, right? When your average cost is potentially minimized. MRMC curve was the earlier question where we said you'll maximize profit as the quantity of profit in the perfect competitive market. Clear? So 4, 5, 6. 4 is kinked model. C is nutrition. C is end form. It is simple, not barriers. And average cost is minimized. Okay, for output model. Okay, when you see profit maximum choice, is this MR equals to MC. Now, last one, a company doing business in monopoly company market will most likely maximize profits when output is set. Yeah, this is similar. Let's go to this one. A market structure is characterized by many sellers with each having some pricing power and differentiation. Simple. What's the answer? If you have product differentiation, then which market is it? Oligopoly? No. Perfect? No, it is monopolistic, right? Monopolistic is where you have to differentiate your products and get money. Correct? A market structure, relatively few sellers, of homogeneous or standardized, is best described as very simple. So when you have large sellers, it is perfect. So the answer is wrong. Monopoly is single seller. So if it's few sellers, the answer is either oligopoly or monopolistic. So luckily oligopoly nahi hai. No, monopolistic nahi hai, so it's oligopoly. Remember, oligopoly is relatively few sellers and monopolistic is where there are sellers, but they're lesser than many. Okay. So many sellers, perfect competition. Few sellers, monopolistic. Relatively few sellers, oligopoly, and one seller, monopoly. So because the answer is relatively few, the answer will be oligopoly. Clear? Okay. Right. And that is with this chapter. Okay. Okay, let's start now the next part of this session. Fairly lighter one. Now the key learning outcome that you want to learn from the session is basically what are the business cycles? What are the phases? We'll also look at the connection between the business cycles and the credit cycles. And we'll describe how the resource use consumer activities are connected through the entire business cycle and how they work. Okay. Now remember the key parts. If you see the learning occurs, how to describe. So you need to learn more on theories out here. Okay. Learn the description bit and try to be ready for theory questions in the area of business cycles. Okay, quick overview of the business cycle. Now, what is business cycles? If you look at a business cycle, it's nothing but the expansion and the contraction, the growth and the decline, right? So every business goes through a cycle of expansion and contraction. So that is called your business cycle. Classical cycle is turnover, where it is fluctuation that you look at in terms of GDP terms, right? That's a classical one where we say the GDP has expanded or contracted, then we know what stage of the cycle we are at. In the growth cycle, we look at the fluctuations, but we look at the long-term growth level. So we actually look at what is the GDP trend, where it should have been towards the actual GDP. Okay. Growth rate cycle, we look at the fluctuation in the actual growth rate of the economy. Okay. So there are two broad types of cycles that can work: classical growth cycle and the growth rate cycle. Okay. Now, a typical cycle of how it goes, right? In the business cycle, broadly, the business cycle, if you remember, there are essentially four parts of the business cycle, right? Four parts. What are those four parts? If you look at it, one is we look at the expansion part. Okay. So the business cycle expanding, expanding, expansion. As the business expands, it will reach a peak, right? So this is expansion. They reach a peak. As they reach a peak, right? Obviously, everyone reach a peak will start declining. Correct? So this is my contraction phase where I'm declining. Now, after it contracts enough, like the peak, it will reach a bottom. That bottom is called the recessionary trough, or like an abyss, the bottom part. It's a recession. After it reach a trough, it will then turn around and again start expanding. Then it reaches a peak. Then it contracts. Then it reaches the trough, expands, peak, contracts, trough. So this cycle continues. Now, obviously, this cycle always continues. What is going to be tricky is how long any one part of the cycle continues. Maybe expansion could for 1 year, 2 years, maybe 5 years. Peak might be for 3 months, 6 months, 9 months, maybe a little longer, maybe shorter. So every part of the cycle that I'm explaining may stay for any amount of time based on the economy's direction. Clear? Okay. So one thing you learn, there are four phases: expansion, peak, the contraction, and the recessionary trough. Right? In all the four phases, something's happening. One increasing, one stops, but it maintains. They start decreasing, then it stops decreasing, but it maintains and then starts increasing. So these four parts of the cycle continue in such a way that economy will obviously go up on an average, right? But these cycles will always show their sides to it in every economy. Clear? Now, what do you mean by recession or expansion? Okay, this is interesting. When there are two consecutive quarters of GDP growth, that is when I can say there is expansion. Okay, so this expansion is going to happen when GDP grows for at least 2 quarters. Obviously, GDP is decline, then recession. GDP is not going up, then you're still in recession. If GDP goes up and goes up twice, then I can say, boss, I'm expansion. If it continues, that's expansion. If it peaks, it stops there, it's showing the same growth, then you're at peak. Then the GDP again starts falling, that is contraction. Clear? Same way. So when is contraction happening? When GDP is having, two consecutive quarters of GDP degrowth. Okay. So growth is expansion, degrowth is contraction. Clear? So contraction, expansion. Trough is obviously where it is stuck. Okay. So this is critical to understand the expansion and the contraction definitions. Clear? And remember, the word is consecutive. Huh? It can't be just 2 quarters, but consecutively GDP has grown or degrown. Right? Now, what happens in each of this in terms of economy, activity, and other aspects? In the expansion period, so from the recovery, the economic activity is starting to build up, right? Remember, it's faced a recession, now it's going up. So the GDP activity, they all are going to start rising because they are stabilized and now they're starting to rise. As they rise in the late expansion, they start growing at a faster rate. Okay. As they grow at a faster rate, they will eventually reach a rate where they stop growing potentially, right? And that is called a decelerating rate of growth. So they're growing, but at a lower rate, right? That means they're peaked. Okay, they're still growing, but growth has slowed down. It's almost steady, almost no growth also. That is where they peaked. They're like, boss, now there's no further growth. Then every peak comes with a decline, right? Because once they peak, now remember, to stay at the peak, you have to do something to continue to stay there. If you don't, then you start declining. That decline is called recession, contraction. That decline continues till it reaches a trough. After a trough, they'll stabilize and again start growing. Then they'll grow faster. Then they'll peak. Then they'll again decline. Then they'll decline, trough, start growing. So that activity is how it happens in the every cycle. Clear? Now, employments are interesting. Employments, a good theory. Employments in the early expansion, remember the sign grow, so obviously they'll start reducing their layoffs, but they will not yet start hiring. This is very important to understand. Even though they're expanding, they have just started to expand, so it's still recovering from the shock, right? So they will not hire. They will start trying to stop the layoffs. When they realize, oh, expansion is actually happening, then they will begin full-time hiring. Clear? So your hiring does not take place, unemployment is still high, but layoffs stop happening. Clear? And they're saying, chalo, yeah, let's try to meet, because we're not sure whether this expansion will continue. So they'll try to rely on overtime. But they'll say, okay, expansion actually happening, then they'll start hiring people, and that time unemployment rate falls. When they reach a peak, they will slow the hiring. They will not stop hiring. They reach the peak, they'll say, chalo, hiring to kam karo. Right? So unemployment also starts falling, but it is going to fall at a low rate. Now, when the contraction happens, that's the first time they will freeze hiring. They'll freeze hiring and they'll start layoffs. Okay. So contraction happens, they'll say, okay, let's start laying off people and stop hiring. Correct? Then when they reach a trough, then the stage, then when they start increasing, they'll stop layoffs, but they'll still not hire. Then they'll hire. Then they'll stop the hiring. Then they'll start laying off. Clear? So it's a very continuous cycle of hiring, firing, hiring, firing. Okay? That's your employment bit. Spending. In the expansion period, people are starting to spend money. Okay? So there's an upturn in spending. Obviously, spending in all areas, right? That upturn becomes more prominent in late expansion. After at the peak, the upturn will start slowing down because it's peaked up, right? So you're trying to spend money to make people spend, but the growth rate is much lower. When the contraction happens, spending is decreased completely. People have stopped spending completely because the contraction isn't happening. Clear? Inflation. Inflation, early expansion is moderate. Then it goes up, so it picks up. Then when it peaks, it's accelerated. Incentives is all-time high, right? Because peaked. And as the peak becomes a recession and contraction, inflation starts accelerating. Clear? So you have to understand this chart in terms of every aspect and understand if they ask you inflation accelerates in which cycle, expansion, peak, contraction, you should know the answer. Sometimes people get it wrong by saying, okay, inflation hai, to matlab expansion mein. No, it is peak. It actually is the peak because peak is where prices are going up. So you should try to understand all these 16 grids. Okay, which one falls in which cycle from an exam point of view. Clear? Very important. And get the logic right more than the answers. Okay. Now, let's move on to the credit cycles. Now, credit cycle obviously refers to expansion and contraction of the credit in the industry, right? So basically how easy to borrow money and invest money, correct? So here the key insights, if we look at how easy to borrow and lend money, right? Business cycles are focusing more on the GDP and the output. As obviously, if you look at lending behavior, they'll try to look at how much GDP, how much output is happening in the industry. Now, when will lending increase. Lending money obviously will increase when people are borrowing money, taking it, but that's when money is needed. And when it's needed, when the economy is strong. Okay. When the economy is weak, the lending will fall. Because obviously people are not having much need for money, right? So credit cycle is the cycle where lending and borrowing happens. That happens when the economy is much stronger and there is more investing and borrowing activities, right? Obviously, as a part of financial cycle, the credit cycle is just one subset of the entire financial cycle. Okay. So remember, the cycle in which you are will always dictate your behavior, like lending behavior, borrowing behavior, the spending habits. That will always be based on a cycle. Credit cycle is one such cycle that's impacted by the stage. Okay. So what are broadly four stages of credit cycle? Okay. Now listen carefully. Easy credit phase. Easy credit phase, which is where credit is easy. Why? Because interest rates are kept low, right? And interest rates being low, people are borrowing more money, right or wrong? If interest rates are low, people will be willing to borrow more money and they will consume the money or they will invest the money into new plants, new industries, new factories, and so on. So borrowing becomes easier and increases. And banks also are more confident and willing to lend because the interest rates are low. So banks also get money at a lower rate and they're able to give at a lower rate, right? So this is called the easy phase. Interests are low, more borrowing, more investing. As the easy phase goes into the credit expansion phase, you're expanding your credit, you're increasing your loans, you're booming your borrowings, you're booming the assets. Borrowings leads to investing, investing leads to assets, asset price go up. All of this increases the overall leverage. Leverage means the amount of borrowing in the economy, right? So all of this, as this is the most important offshoot, asset price go up because more people borrow money and invest in more houses, house price go up, shoots up, real estate price go up, right? The biggest problem with this is the risk of asset bubbles. Asset prices may shoot up and may become a bubble. That is the biggest risk out here, correct? This is the credit expansion stage. Then there's a credit stress phase. Credit stress. Credit stress phase is where there's a stress in the credit period because loans defaults are starting to happen, right? Here the law stress, people are starting to default on loans, on interest. So banks are becoming more cautious and therefore they will not lend as easily as they would lend earlier, right? Why? Because they'll tighten lens and they'll probably say, okay, I will look at credit rating, they will look at CIBIL, they will start looking at down payment. So all of this will lead to people to reduce the lending. Clear? They're tightening the norms. Okay? And that's because people are defaulting. Then comes the contraction, where now they're not reduced it, they just stopped lending. Right? And because they stopped lending, liquid dries up. Now remember, if there's no liquidity in the market, lending or the liquid is reducing, obviously the activity in the economy also will dry up because there's no money to lend to borrow, then there's no investments happening, there's no growth, there's no production, and all of that leads to a slowdown in the economic activity. Clear? And this is what leads to a financial crisis or a recession. Okay? So this cycle that you see is something that keeps repeating. Okay? Obviously, it repeats as it is. And when the cycle repeats, the policy will eventually keep changing and the RBI will intervene. If they say, okay, the credit crunch, they'll try to intervene. They'll try to reduce the interest rates. They'll try to make credit more easily available. So if you see liquidity is drying up, then you'll say, fine, let us increase the liquidity. They'll try to make money available. People start spending more. Consumption goes up. Activity increases. They should make sure they control it in such a way that assets don't rise up. So, this entire cycle that you see is critical and follows a staged approach. And this is where the regulator, the monetary agency have to take steps to make sure that this is followed to the T. Clear? Credit cycle. Okay. Now, if you compare or superimpose the credit cycle with the business cycle, right? Now, the business cycle is what? My activities, production, and output and so on. So, business cycle is all about GDP. This looks at what is the GDP, what is the output. The credit cycle looks after lending and borrowing. How much credit is there, how much lending is giving, how much borrowing is giving. That is the credit cycle. So business cycle, economic activity, credit cycle, loans and borrowings. Right? Now, obviously, there's a strict interconnection here. Credit cycle often, often leads to the business cycle. Because as you lend more money or you make lending cheap, that increased lending will lead to increased investment. Increased investment will also lead to increased consumption, increased production, and increased GDP. But that will also further lead to increased asset prices. Right or wrong? So credit cycle directly impacts the business cycle in all economies, right? And this is more connected to GDP, right? Obviously, that is why every country's cycle is always impacted by the credit policies of that country. Okay, and it matters a lot. Correct? Economic impact credit cycles, strong growth, right? Expansion. If there's more credit growth, there's more expansion. Obviously, it may increase matters. If you give too much lending, too much borrowing, too much money, there may be inflation, there may be systematic risk, and so on. And sharp credit contractions, if it's there, that may lead to a faster recession. So you have to make sure that there's sufficient expansion, but at the same time, it is not over because always an expansion is followed by contraction. So you have to make sure that the contraction recession is not too much and it's not sudden. Okay, so it has to be maintained. And that's why credit cycles and business cycles are always viewed together. Okay, and this is a very interesting cycle. Most crises are usually preceded by prolonged periods of expansion. So, it's always scary. If there's a large expansion, it is always bound to be followed by a contraction. So it's important to make sure that the expansions happen, but not too wildly. Why do you have 2008 crisis took place? Because there's so much of growth, loans, asset price going up, house price going up. There's such a huge expansion and growth in price that eventually it crashed in 2008 and it came down to reality. Clear? So that is the how the cycles will go, credit and business cycles, right? If you look at the application of credit cycles, it explains how it can explain why some recessions take place. Obviously, if you look at the nature of recession crisis, some are stronger, some are lighter. They impact you, right? But disruptions happen. And when the disruption happen in the market, right, in the credit cycle, in the lending, these disruptions will always go and impact the entire economy. It'll impact the banks, it'll impact the individuals, it'll impact the companies, the firms, it'll impact the people who are investing, it'll impact the prices of real estate, commodity, and so on. So any disruption is bound to impact all the players in the market. Correct? And this is why it's important to connect the two dots, right? Now, if you look at crisis, what role does credits make in the what role credit play in the final crisis? This is very clearly akin to what happened in 2008. If there's loose credit, right? If people start giving loans without checking the borrowing capability, then what will happen? The loans may go bad, the assets may fall, the bubble gets created, and with that bubble, there may be a crash in the asset prices. So remember, once a bubble is formed, if that bubble bursts, it can lead to what exactly happened during 2008-9 when the asset prices collapsed. Correct? So therefore, and obviously, if you read that a bit, you realize the 2008 crisis took place because the credit lending standards were very loose, and they were giving credit to every other person without checking the background, down payment, and so on. So that led to an eventual bubble, the financial crisis. Okay. Interaction between credit and business cycles, obviously. So the large interaction between the two credit cycles and business cycles, they are interconnected. Okay. Recessions normally are caused accompanied by financial stress. Clear? If there is a credit stress, if there's a financial stress in the economy, then the recessions is bound to happen, and that will also last much longer, right? See, if a credit cycle leads to a recession, then that cycle needs to be broken. That takes a much longer time. Okay, if the recession took place because of GDP changing market activity, then it's easy to break it up because then the GDP increases, consumption goes up, and so on. But if the credit cycle and the financial stress caused it, right, and accompanies that, then it's difficult because both have to be tackled, and it causes a larger economic damage. Clear? If there is a strong credit growth, if there's a recession, but credit is good, then you can recover much faster, right? Because the credit policies can change, the growth can happen in the credit cycle. So that is much easier to pick up. So, like I told you sometime back, the duration of every cycle is very different, and it completely depends on what is the conditions in the economy. So the depth and duration of the business cycles completely heavily depends on the underlying credit conditions. Clear? Okay. And this is how the interconnection should be understood. That's why we read these together for looking at credit cycles. Clear? Now, if you look at the interconnection in the business cycle credit cycle, right? What is the focus area? This is summary what I've discussed so far. In the business cycle, you focus only on GDP and output. What's the gross domestic product? What's the output? You focus on the economic activity. In the lending credit cycle, you focus on what is the lending, what is the borrowing, what is the amount of loans and all in the industry. Clear? So one focus on economic activity, one focus on financial lending borrowing. The length of every business cycle is much shorter compared to the longer credit cycle because in the business cycle you have production, you may have expansion, then you have recovery, then you have contraction. Here the cycle is much longer because the effect of the lending borrowing will translate into investment, higher prices, so on. That takes time. You won't say you don't save money and go invest, right? Money comes, you keep investing money, you take borrow. It's a longer cycle compared to business cycle, right? And because it's potentially longer cycle, the impact is more difficult to be curtailed, right? The volatility wise, right? Here it is more moderate compared to credit cycle where it's more extreme because it impacts very quickly, right? And the impact of business cycle is economic and here it is financial. So if a business cycle which affects the economic activity is impacted, it will bring down your economic activity and lead to economic slowdown. But a credit cycle which looks after financial angle of lending borrowing will result in a financial crisis. Clear? So do remember this key point that a credit cycle will always be longer. It'll have a much, much deeper impact compared to a business cycle because it directly affects a financial crisis. Clear? So give me 1 minute. Okay. Now quickly, obviously you realize credit cycles are much longer, have a bigger impact. Therefore, our investors, policymakers, all of them, they track the business cycle, credit cycle, because it's so important. It has a bigger impact, right? So they track it to make sure they take the right decisions in the economy, right? What are practical use of credit cycles? Right? They look at what is the financial imbalances. They try to identify where's the imbalance, where are the lending, where's the amount of money in the economy, where's the mismatch happening. They try to look at whether there's likely to be any business banking crisis, right? And this helps you to predict not just when a recession will happen, but also what's the severity of recession. Is it likely to happen? How much it might impact? What is the broad, you know, repercussion of that? And this is the biggest guiding factor for RBI, the government to make monetary policies, macro policies, prudential policies, regulatory policies, tax policies. All of these imbalances, crisis, recession, and other factors helps the governments to guide and make their policies. Clear? Therefore, it's very important that the credit growth of the economy is monitored, is understood so that you can maintain financial stability, right? So if the economy is strong, right? Let's answer the flow. Let's understand the flow of transactions. This is very critical. Okay. If the economy is strong, there'll be more GDP, more production. That will lead to more consumption, right? More consumption lead to more money required. There'll be better lending. There'll be more borrowing. People lend and borrow more, right? And with that more lending, there'll be credit expansion. As people borrow more and lend more, they will consume more and they'll also invest more. Investment in real estate and other assets will lead to asset bubbles, right? Now, as the asset pricing bubbles go up, asset price go up, the consumption increase, lending increases, there comes a stage when people lend and borrow so much that they're not able to pay. So that peak that they reached might result in a crisis because they are defaulting. If people start defaulting, then people start reducing the lending, they'll take back the loans, and that leads to contraction. Now, don't forget, a contraction may lead to people having to sell the assets. They'll yaar, paisa dena, they'll sell the assets. As the assets start being sold, all the assets fall, the asset prices start declining, right? And as the assets prices are declining, the lending stops, borrowing stops, the liquidity dries up. That leads you to a recession. So this flow that you understood right now, right? Expansion to price bubbles, to credit cycles, to recession, contraction, they'll repay the loans, asset price. This will continue. But it's important that you put policies which will ensure that the severity of the impact is not impacted. Is that clear? And that's the most critical aspect. Okay. So let's look at some indicators here to make an impact. Okay. What are the indicators here that help you understand? That help you to understand which stage of the economy are you at? Okay. Now, broadly, there are three types of indicators in the economy. There is leading indicator, coincident indicator, and lagging indicator. Okay. This is not an indicator, this is an index. Okay. So learn the three indicators. A leading indicator, as the name suggests, it's a leading indicator. It will be an indicator leading to where the economy is headed to. So this indicator will explain or highlight the leading part. Okay. Where the economy is it? Is it going to go to recession, expansion, contraction? So these indicators are leading indicators. Coincident is where it explains where we are today at. This indicator will help you understand that are we already in a recession or a expansion or contraction where we are. And a lagging indicator helps to understand where the economy has come from. Okay. If the indicator is obviously positive, then it shows that, oh, it is come from a recession and now probably going towards. So each indicator gives you a different idea. So obviously it's important for you to learn the three and interpret them together to understand where are we today. Are we in a expansion, growth, peak, and so on? Are we clear? Example, stock market. The stock market, if the stock markets are going up, it's a leading indicator, means it's indicating that the economy is going to expand further. It does not mean that the economy expand. It just means the economy is going to further expand. If the house prices are increasing, it's a leading indicator. Tomorrow the prices may go up. It may become a bubble, right? It's indicating what's going to happen. Understood? Personal income is probably gone up. It shows that, boss, that means we are in a good situation. It's a boom, or it's a economic growth, right? It shows where we are. And let's say unemployment rate has reduced. That means, oh, it's reduced. So that means we were in a contraction. It is now looking towards going to the next stage. Clear? So these indicators explain to you either leading where we are going, where we are, or where we have come from. If you look at a diffusion index, this index will combine all the indicators and then measure the extent to which they move in the same. So it will try to find out, okay, Was the leading saying, oh, we are going to a growth? Fine. Is the coincidence showing that we are somewhere in the recovery? Okay. Is the lagging showing that we were in recession? Yeah. So then it will combine the three to study and then give a intelligent response as to what is the economic situation that we are in. Clear? Okay, so the three indicators are very important, but on its own, they can't be interpreted. You have to combine the knowledge and try to come to one collective answer as to a direction in which the economy is being headed to. Clear? So those are the economic indicators. Okay. And lastly, the cycle fluctuations. If you look at cycles, right, you do understand that the cycles will help companies decide what to do, right? Example, if the cycle is in a contraction, when COVID happened, what did all the companies do? They started cutting costs, right? They started reducing costs, they started reducing overspending, they rationalized, they started making sure that people are not being laid off, but they're covering the cost because they certainly can't lay off people and hire people. They can't just throw people and then hire. That also involves cost. So they have to make sure that they're maintaining people, but same time reducing the irrelevant cost. But if the contraction becomes very long, then they'll have to go for aggressive cost cutting. And at this stage, they may end up removing people, firing people, laying off the workers, and so on. Clear? So it depends on how long it is. If the contract is small, they won't lay off. If it's longer, then they may have to lay off people, right? And they'll have to start spending less on capital intensive cost, right? Obviously, with prolonged production fall, people try to liquidate what they have. Like COVID time, all the inventory was liquidated. They try to generate cash from the inventory. They're not buying much because demand had fallen, right? So decline in aggregate demand is there. Now, if the demand declines, production declines, then people who are earning wages, their wages also will fall down, salaries go down, the demand goes down further, right? And the production overall falls. So this leads to a recession. Now, what will the government do? They will come and they'll cut the interest rates. They'll try to improve the economy. They'll try to increase the activity and say, fine, let's reduce interest rates. So money is able at a cheaper rate. So people borrow money, they'll be able to demand more goods, consumption increases, production increases, and the economy will revive. Yeah, that's what I was saying. If people purchase more goods, and this is the turning point. See, remember, guys, if people don't purchase goods, then production can't happen, right? Because production will happen only if they're able to sell. As they sell, GDP goes up, but that's only if people are buying. Now, if you want people to buy, you have to try to make sure that there is cash available, credit available, funding available, and that can be done by making funds cheaply available for the people. Okay. So it's all very well interconnected. You have to just read the dots and understand them, right? And this is exactly what, now this is very, very important. Please remember this carefully, which explains what happens in every phase of the economy. Recovery, expansion, slowdown, contraction, right? So in recovery, what happens? The economy is at the trough, bottom level. It starts picking up, right? The economy has trough and it starts to pick up, right? And that's when the gap closes. At expansion, the economy is fully enjoying. Okay, it's going up, it's going at a faster rate, right? And it's peaking. When it peaks, I'll call it slow down because it's already peaked. It's peaked. Now it starts to decelerate, right? It may start having some shortage on. It's peaked out and now it's going to be falling. When it starts falling, I call it contraction. Contraction, when it happens for a longer period, that leads you to a recession. So contraction that is severe is called a recession. Clear? Okay, so very easy to understand. Trough, recovery, expansion, peak, contraction. Very easy to get. Now, more important to understand is what's the employment situation. When you're recovering, right? They will stop layoffs. They say, boss, we're recovering, right? So stop, but they won't hire. They will go for overtime. They will not hire because they're still not sure whether we should hire because we are just recovering. So unemployment is still high. When they start expanding, they'll say, boss, fine, time to hire. So they'll start hiring. Because they're hiring, unemployment rate falls. right? Now, when they reach a slowdown, so okay, boss, hang on, we are slowing down. So then they'll again uh, hire, but at a slow. They'll at least start to revisit hiring, but they'll lay off people if the people are needed, right? But they will hire at a slow rate, correct? Now, when they reach contract, they're like, okay, dude, we are really falling. That time they will start laying off people, but they'll still not fire people. They'll try to make sure that people are laid off, but they'll not, sorry, they'll stop hiring people. Okay? They'll stop hiring people. So here they'll say, boss, let's not hire and maybe lay off if needed. When they reach the bottom, they fired everyone. Then they'll say, fine, let's stop firing because we are now sort of going to recover, but let's not hire. When they now go up, they'll say, okay, let's start hiring. Okay. So remember, it is a situation where you have to look at what is the next stage of it. Okay. They will start firing people when they feel like contraction ho raha hai, let's fire. But the firing stops when they are looking to recover, right? But they will hire only when they are growing. Okay. So the certainty is very important. And this is why employment, unemployment rates make a big difference based on the cycle that you are at. Clear, guys? So this slide I find is very important from a business cycle because they'll ask you questions where they'll ask you to identify which cycle am I at, and then you have to get the right answer. Clear? Okay. So let's really look at, I think we have 3 questions only. Uh, there should be more, but you like more practice questions when you do the others. Quickly look at this and tell me what is the answers. Inventories tend to rise when? Read carefully. When do inventory tend to rise? Now, inventories will rise when the inventory to sales ratio is low or high, or when the activity begins to rebound. Obviously, if the activity rebounding, then obviously you will sell more, right? Your sales will increase. So then your inventory is meant to fall. So this can't be right answer. Right? So what is it? When your ratio is high or ratio is low? So if your inventory to sales ratio is low, that means your inventory which you're selling, right, is low. Then your inventory figures are building up, right? Because the sales ratio is much lower. That means your inventory is turning over much lower, right? Now, inventory sales ratio is nothing but your inventory turnover ratio, which means it is nothing but your COGS upon inventory, right? Is your inventory turnover ratio. If your COGS upon inventory is reducing, that means your inventory is increasing, correct? So your answer will be A. Inventory to sales ratio is low. Here. What's a diffusion index? Does it measure growth? Obviously not. It's a diffusion index, looks at the indicators, right? Leading, lagging, coincident, and tries to look at, combine the indicators and come to one answer as to what is the phase of the economy. So what is it? Is it analogous to the indices used to measure production? Not at all. It is indicators, and it reflects the consensus change in the indicators by looking at the leading, right, the coincident, and the lagging. Correct? It takes a consensus of all these indicators and finds out what is the direction of the economy. What consensus are these 3 indicators showing to you? Clear? The contraction phase of the business cycle. Okay, now if you say business cycle, I had recession trough, right? I had expansion, I had peak, then I had contraction, and then recession, right? Now they ask you a contraction phase. So that is this part of the phase, contraction and then recession. This phase is least likely accompanied by. Okay. So what is it not accompanied? Least likely means not, right? So it's not accompanied by what? Decreasing unemployment, decreasing inflation pressure, or decreasing output. Now let's understand. When you are in a contraction phase, your output is obviously decreasing because you're contracting. So this is not the answer because it is accompanied by output decrease, obviously, right? What else? Is there is not accompanied by decreasing okay. So is it accompanied by decreasing inflation or decreasing unemployment? See, the question is not accompanied. So you need to think of it. What is normally accompanied? It is obviously accompanied by economic output decreasing. What is the other things accompanied by? You can eliminate that also. Is the unemployment decreasing or is the inflation pressure decreasing? Okay. Now, obviously, realize that when you are contracting, right, that means you are reducing output. Your unemployment is bound to increase, no? Because you are trying to fire people. Your layoffs are increasing. So unemployment is definitely not decreasing. It is increasing. That's the correct answer because it is not accompanied by decreasing unemployment. It is accompanied by increasing unemployment, right? And inflation, what is inflation? Inflation is the price rises. Is it not accompanied by decreasing inflation potentially? Okay. Now, because the output is decreasing, obviously, the inflation potentially also would be decreasing, right? Because output is decreasing, recession है, तो prices भी तो गिरेगा ना? So prices के साथ inflation pressure also will reduce. So there is a decreasing inflation, there is a decreasing output, but there is an increasing unemployment. Are we clear? Okay. So contraction phase में there is increasing unemployment, decreasing inflation, and decreasing output. So it's a very intelligent question. See, in the exam, you have to learn how to answer these questions. There's a contraction phase, and it's a not likely accompanied by decreasing. So you have to understand least likely means not accompanied, but not accompanied by decreasing. So is unemployment decreasing? No, so it is not. So that's the correct answer, right? Not and decreasing. So look at the correct answers. If you choose, you can say what is actually decreasing. You can say this is not decreasing, but this is decreasing, this is decreasing. So these two are wrong answers. So try to eliminate the answers and then find the right answer, or try to find the right answer directly. But please don't get lost in the language because sometimes the language can make a big difference. Is that clear? So here we know unemployment is actually increasing and therefore the answer is A. Clear? C. Increasing unemployment. Clear? Okay. So that is it from the business cycles, industry cycles, indicators, quite a bit of stuff. This is obviously macroeconomics, credit cycles, business cycles. We understood how the cycles work. Very interesting. And you have to understand it more than trying to ratify it. Do not study by rote these concepts. Try to study the way I explained to you how the activity goes. Understand the logic behind it, because only then you'll be able to answer the question. The questions here are quite tricky here, right? Learn the 4 stages, learn the business cycle, the impact of the stages on the business cycle, and please attempt the questions. And every question I get wrong, please go back and read the logic behind it. Clear? Because each are like indicators, you have to understand leading KL, coincident lag. They sometimes ask you which are following the lag indicator. They give you 3 options. So understand which indicators what and the reasons why. And what does the real do? Diffusion index combines 3 indicators, gives you a summary of that, gives the indication of where the economy is leading to. Business cycle, understand all of these like logic and attempt the question, and then you get the right answers. Clear? So with that, we've done the business cycles indicators. Next week, we'll start with the fiscal policy, right? All about taxes, income taxes, how they work, revenue, cost, investments, how the government spends money, earns money, right? For taxes, for investment, and how that is decided, how that leads to a surplus or a deficit, and how that is managed for moving the economy in the right direction. Clear? So again, that's macroeconomics. We'll pick it up next week along with the relevant theory. Clear, guys? If you want to keep the annotations and try to share them with you later with the annotations, you can refer to that. Okay, sure. Bye, guys.